Welcome everybody, I'm your designated Inquirer. My name is Axel and welcome to another market day for 7/27/2020. This week is going to be an amazing week in terms of activity for economic indicators and other things that might move the market either up or down, as we have a lot going on. We've got a Fed meeting, which is the Federal Reserve. They go ahead and they have a meeting basically once a quarter and or when they deem it necessary. Sometimes it's once a month, but major news, etc., things, they usually have it about once a quarter. And then general meetings, possibly like Fed minutes, etc., and stuff like that, once a month to give small updates and things like that of that nature. But in any case, even when it's small meetings, especially considering what's going on with the economy right now, every meeting is important. There should generally, people are expecting not a lot to happen in terms of the rhetoric. Every word that happens to be spoken by the Fed is seen through a microscopic lens. They know this. Every word that they say is measured. Everything has an effect. Their speech is somewhat crafted to reflect this. So there isn't a whole lot of change that the market is expecting as far as the Fed is concerned. Congress is basically getting together this week to try and determine what sort of stimulus package they have to put together to keep the economy from falling off of a cliff, because we're basically at the edge of the abyss at the moment. And if they don't come together and actually do something meaningful, we're going to be in a world of pain. And here's a little bit of the problem for this coming week. If they don't do enough, there's going to be a lot of us that still experience a lot of pain. And a lot of pain economically is going to translate to decreased earnings, not as robust economic activity as to what is currently priced in right now. The market fully expects basically still a complete recovery by like summer of next year, which I still think is ludicrous. I don't think that's going to happen. Right now, we're still above 10% unemployment for going on the second quarter now. And some people think that somehow we've now stopped contracting in terms of an economy when there's 9% unemployment. That doesn't seem. I don't know by what measure people are going off of to think that that's an okay number to have. As with any negotiation, you can have one party start off high, you can have one party start off low, and so the Democrats back in May pushed their agenda forward as their starting point, which they're basically starting off high. Republicans finally got their act together and pushed out something this week, or probably are going to announce it today, as to their starting point, which is starting off low. If we take at some point in the middle, depending on where it lands, considering that both the Senate and the president currently hold more of the power, it's probably going to be somewhere smaller than, of course, than where we're at now. And if we're basing a measurement off of where we're at now and the economic activity that we're currently facing versus less, then there's going to be less economic activity that's probably going to be happening, considering what the starting point the Republicans are at. And just for reference, we're currently right now sitting on $600 a week of unemployment assistance on top of what is unemployment, and that's a week. So that's $2,400 a month extra in terms of benefit for people that are currently out of work because they have to, because they don't want to go to work and get sick and get their loved ones sick, and that where their loved ones could possibly have high risk and die. You know, it's not just for any reason that people are not going to work. Um, but this is where we're at. And Republicans are basically putting forth a third. So whatever economic activity we're currently enjoying from the lower 25% of basically the economy and or more, because as far as a low income and middle income, which a lot of probably depend off of these unemployment payments at the moment, if you're going to be cutting their income down by a third of at least that benefit, even though some may counter and say like, well, it's to a third of that increased benefit, but a lot of people don't really get a whole lot of unemployment to begin with, so it's really difficult to try and argue that it's not going to be a major part of their income. So it's going to be a major factor, I believe. They are planning to put forth one more stimulus check of $1,200 per person, but the cutoff amount is going to be substantially less from what I understand. So there's a lot fewer checks that are going to be going out. Apart from this, there have been arguments that I've seen being bandied about as to why some people expect, for example, the ES, or basically the S&P 500, which I'll put up right now. ES. This is the S&P 500. They're basically looking at these levels right here, and they're fully expecting for this to be basically reach above 3,300. So it's supposed to go up and above the all-time highs to about here. Where if we're taking a look at basically where we were before, the general economy, which is a good measure of what the S&P is a description of the general economy apart from the Dow Jones. We're supposed to be at or above the all-time high that the stock market had reached, where the stock market before February was taking into account growth, etc., and still a somewhat shaky economy due to the trade war, which we still haven't recovered yet from. So I'm not sure where these valuations are coming from. I don't see it, but something that they're arguing as to a reason why this is a somehow logical number to aim for and that it's okay to get to is because of what the Fed is currently doing in terms of stimulus or providing liquidity. And so why would this be the case in their view is because the amount of money that it's giving away cheap money, right? But not necessarily for any sort of trade in terms of trade for stuff getting made, right? Because the amount of stuff that's currently getting made is dropping. That's why we're basically going to be seeing later this week that the Bureau of Economic Analysis is going to put out our GDP number for the second quarter of this year. And for the second quarter of this year, we're going to see a number vary between north of 25% decline and or as high as 40%. So depending on where we hit that number is going to tell you exactly how bad it got in terms of a hit to our gross national product, gross domestic product, GDP. That's an insane amount. Something that isn't like a recession in normal terms, in normal times, happens because of a disruption in the economic activity of the United States. But when you're talking a disruption for a quarter where we're talking 33% decline in stuff getting made and or services being rendered, that's an insane amount to try and recover from. Even if you're increasing from quarter to quarter a percentage of growth, the percentage of growth that would have to come from in this next third quarter would have to be an increase of about the same, if not more, to be able to overcome the loss and or even get to approaching the loss that we experienced in the second quarter, which I'm not seeing as the case is happening. There's been some percentages of economic activity that have been able to come back because we've been able to work with and maneuver around and change how we go about getting work done. But it's not necessarily that the consumer feels safe enough to do the things that we had been doing before the crisis hit. I don't think that's the case. So and that's what I feel like is what they're missing. They were basically considering applying a multiple of about 22, 25 to what is basically GDP, or what is the forward earnings looking at the S&P, and being able to apply a 3,300 or 3,600 like number to it, and that being okay, where we have basically unlimited printing by the Fed. The problem here is that being able to just simply apply forward to the forward earnings, like, and when I say that, I mean to the expected earnings of companies, to be able to pay a multiple to it, and that's basically the number, that's basically the value that you're giving the company and or the entity. In this case, it's an ETF, which is an amalgamation of all these companies put together. Now, respective of how much this ETF owns of all of these companies, the problem was simply assigning a forward-looking multiple to simply being able to print and borrow and just being able to buy more stock, is that nothing is actually getting made. Nothing. And looking forward, it's going to be less things that are going to be able to be bought, considering that more people are not going to have a job. And so if the multiple is going to have to increase dramatically for you to be able to justify that price multiple that you're paying. So it's either going to have to contract substantially the price that you're paying per share to be able to even keep the same price multiple, or you're going to have to, that's basically it, or you're going to have to produce more. But I don't see a way in which this economy is going to be rapidly deploying the ability to produce more. If we're going to be cutting jobs and cutting the ability to make more, there isn't really a mechanism in which people can then buy more stuff. So both sides of the equation kind of have to come down to be able to compensate for the lack of economic activity, because you don't want prices to drop dramatically less, and you don't want to just produce to a market that's not buying, because then your stuff will decrease in price to a certain extent where you're wasting your time and your costs are staying the same, but you're making less profit, and so you're losing even more money faster in just producing to a market that's not able to consume what you're producing. In either case, there isn't really something in this scenario where a higher multiple is something that you actually want to pay for, where a higher multiple is justified, even if you are a Facebook, even if you are a Logitech, AMD and Nvidia, like any of these companies. Without the consumer being able to feel safer about spending, without a consumer having more money to spend, i.e. jobs, etc., I still don't see companies rushing to hire to such an extent that can overcompensate for the amount of retail jobs and other industries that have had to cut dramatically the amount of people that they've hired and or have been employed since February. There isn't a place where all of these people can just simply from a wave of one, now be able to transition to a completely different sector of the economy and to be able to produce at the same rate at which they were producing in their original sector. There just isn't. And we're basically closing down schools that can't teach. More online schools have to try and produce more with either less teachers, less tuition money available. Like, some people are going to be able to pay, but like, it's all very difficult. It's all very difficult without necessarily a vaccine being already out, without a substantial amount of testing, more testing being able to get done so that people feel safe and can have confidence that somebody that is not sick can continue to be not sick, and to be able to perform services and duties that can increase general GDP of the country and or businesses, etc. The conditions are not there. The conditions are not live in the general economy for those things to continue. There are marginal instances where some companies can still produce more marginally, but not to such an extent that can overcompensate for the decrease in general like diminished productivity for the rest of the economy. It's not there. So that's where I would say, for as quickly as the Fed has acted, because they had to, because there was already weakness being shown by the economy late last year, early this year, with those, the Fed was acting in fear. The Fed is still acting based off of fear because it feels like it has to, or else everything falls apart. If there is any hesitation by either the Fed and or this upcoming stimulus package right now, we're still going to be seeing a downturn in economic output from this country. Nothing has really changed over the weekend. Nothing has changed substantially that would be able to justify an increase today, simply because people there's still money sitting on the sidelines, and from a technical standpoint, they try to give it a run, because there is basically some form of we're kind of waffling about here because we're waiting for more information, but this general trend of producing lower lows, etc., got partially broken, but because of what happened basically this Sunday, where we had some vaccine news, but that didn't really result in dramatically different situation that's live on the ground right now. And for what happened generally today, things haven't changed that dramatically, so people are mostly just acting from a technical standpoint as to where they can possibly get to. This is simply price exploration that we're seeing right here in this area. There isn't really a reason as to why a general reason as to why this could have happened today. You're just doing it just because. And they may hit this part right here, this price level, and decide to turn around. If they do try and test this, it's not going to be because there's now more positive information that it's about, and they're trying to test the highs, the all-time highs. Like, is that going to be a reason to reach higher highs? I don't think so. But we're going to need for sure the rest of the information that's coming out this week, including the people that are reporting, the information that's going to be coming out from Congress and the Fed. All those things we're going to have to see to get a better picture of what the economy looks like going forward. So till then, stay tuned, but that's basically your market day for 7/27/2020. Take care, guys, and I will catch you later.